Good afternoon, ladies and gentlemen. My name is Colin Rezek. I'd like to all welcome you to our first Southern African Lebanese Chamber of Commerce event for the year. And as we can see, it's a web event, which is just the sign of the times. What can we say? 2020 has brought unprecedented times to the world, not only to South Africa, and not only to Lebanon. Today, we are going to talk about our two beautiful countries. To many of us, it's a country of origin, and to many of us, South Africa is a country of birth. We're now sitting in times where COVID is a buzzword, and some words that spin off are something called COVID crater. And COVID crater means the diversity between the rich and the poor, the gap between the haves and the have-nots has got larger, and COVID is creating it to become even larger, which is very sad. It's very sad for the whole world, very sad. Today we're talking about South Africa, we're talking about Lebanon. We have three specialists on our panel today who I will introduce as they're about to talk. But I think what is very important for us is to understand that these two countries are in dire straits. In the world, we talk about the developed world, countries like the United States, France, England, etc. And then we talk about the emerging markets. The emerging market worlds is something that came about 10 years ago when countries were identified as countries of promise, countries of big populations, potential high growth, and these markets were hoping, or many were hoping, would develop into developed markets. These emerging markets, however, have now been subdivided. People are now talking about not only emerging markets as against developed markets, but they're talking about sub-markets. And sub-markets are those emerging markets who are not living up to expectation, who are not growing, who have problems internally, have problems, I think, just in general. These markets, I like to call them more like stalled markets. Stalled market means maybe they've stopped, but they will hopefully ignite again. And we hope this is more evident in countries that we know of, like South Africa and Lebanon. If we look at both these countries, they've had amazing histories. South Africa with apartheid, the glory days of Mandela era, the World Cup, and things looked so positive. Unfortunately, things have changed. If we look at Lebanon, they went through a civil war. The civil war also dramatic effects. We then had the reconstruction of Beirut and Lebanon. And Lebanon came back as a tourist destination, as the Paris of the Middle East, as the Switzerland of the Middle East. But here we sit today with both these countries facing many, many challenges. And we're going to talk about the state of these two countries from a macro, from a micro perspective. And we're going to see and hopefully find some positiveness, find some opportunities to help us take these countries back to emerging markets and back to a place in the world where they were and where they will be or could be over time. We have three panelists today joining me. The first one is Ali Houmani. Ali is the deputy head of the Lebanese mission in South Africa. And today, Ali, welcome to our panel. And I'd just like to say as an introductory that Lebanon is facing some very difficult times. We see in the news currency dropping 80%, shortage of dollars, poverty on the streets, and many more, which I won't go into detail because I'm sure you'll be able to enlighten us on all these issues. So Ali, I'll leave it to you. Thank you.
Thank you, Colin. Welcome to all. I'm glad to see you all safe and sound during these conditions, dire conditions everywhere. Well, I'm not going back so far. I'm just going to say that economic growth in Lebanon has been slowing down since 2011, following the Syrian conflict and the massive influx of refugees and intense internal political tensions. In 2019, the economy experienced a sharp deterioration. GDP growth decreased by negative 6.5%, and it even decreased more to negative 12% in 2020. The debt to GDP in 2019 was 155% and expected to reach exceed 160% in 2020. And these are according to IMF estimates. Now, basically what happened is that governments spent more than it could collect in taxes. And they funded the resulting deficit by paying very high interest rates on bonds issued for a long time, basically for 2035. Eventually, the government was forced to default on foreign bonds that were due in March, the $1.5 billion. This deficiency triggered a sharp drop in the exchange rate of the Lebanese pound on the black market, and also triggered a high inflation rate of almost 90%. Now, in the same context of economic slowdown and declining of transfers of Lebanese migrants and deposits in 2019, in the second half of 2019, now, banks did not have enough dollars to trade. So controls or restrictions or limitations, call it whatever you want, have been imposed on withdrawals to avoid collapse. Savings were frozen, and capital control, actually unofficial capital control, was imposed on Lebanese depositors. And all of this only led to further deterioration of the living conditions, and it worsened the situation of Lebanese import-based companies. Now, if I have to describe the last 3 months of what's happening in Lebanon, I would say that what I see is increasing operations of closing establishment and businesses, commercial, industrial, touristic businesses. Actually, in June, I think the number was 563 companies and restaurants and whatever. These closings were accompanied by layoffs for workers and employees. Many did not receive compensations on the pretext of financial bankruptcy. Employment in 2020 slowed by 70%, and the employment rate reached about 30% in 2019, and expected to exceed 60% in 2020 if we added about 10,000 Lebanese workers from abroad that would be returning because they lost their jobs due to all the repercussions of the COVID-19 pandemic on the global economy. Now, with the collapse of the national currency, the exchange rate and the salaries, with the collapse of the national currency, the salaries have lost more than 80% of its value. We have 90 to 95% of the workforce in Lebanon. They get paid in Lebanese currency, in the national currency, and their purchasing power was eroded as a result of the collapse of the lira exchange rate to the dollar. This led to a significant increase of the value of the food basket. The food basket amounted to 450,000 Lebanese pounds in 2019, but today it's a bit over 1 million Lebanese pounds, which is like 120% increase. The dollar reserves are being depleted in order to import vital subsidies such as wheat, medicine, and fuel, and also to support the food basket. Now, in order to curb this massive deterioration of the economy. What the government did is what the government did was adopted in April, adopted an economic recovery plan. This plan is based on the need to start implementing all the long-awaited reforms at all state levels, financial, administrative, central bank, balance of payments, etc. This plan is based on the foundation to allow Lebanon obtain the international financial support that is required to relaunch the economic wave. Now, Lebanon started negotiating with the IMF and is seeking to conclude a deal with the IMF in order to obtain a soft loan of $10 billion at low interest rates. Now, an agreement with the IMF is very important to the government because its entire plan relies on this deal. The government believes that in the process of recovering international donors' confidence and even the diaspora confidence in Lebanon, they feel that an agreement with the IMF would send a signal or a message to the donors that the required reforms have been implemented, or at least are being implemented properly. The target is that most of the reforms will be implemented by the end of this year. And if it all works well for the government, they will be expecting results within 2024. So as we know, there are prerequisites to have agreements with the IMF. The IMF required reforms include reducing public expenditure, improving tax revenues, controlling borders, and most importantly, repairing the public service sector or public utilities. Foremost of which, as you know, is the electricity sector, which has cost the state over $40 billion since 1990. And there's also the waste crisis, which began in 2015 and is yet to be resolved. Recently, the talks with the IMF have been suspended, pending that the Lebanese side reaches an agreement on the size of the financial loss. The government estimated these losses at 260 trillion Lebanese pounds, while the fact-finding parliamentary committee said that losses did not exceed 90 trillion Lebanese pounds. Actually, the IMF believes that the figures given by the government are closer to reality. Now, this picture is as dark as it seems, actually, but there are some positive points that may constitute really an opportunity to build on for the next stage for Lebanon. Even they constitute some investment opportunities in Lebanon. And some say that in such situations you can find opportunities that you can't find somewhere else. For instance, Lebanese products now are cheaper because of the devaluation of the Lebanese lira, the Lebanese pound, which gives them a bigger chance to compete in the foreign market. That's a positive point. Also, the trade balance in Lebanon has always suffered from an annual deficit ranging between 17 to 18 billion dollars. It's due to the high import bill or annual import bill, which is estimated at about $20 billion against shy exports, very shy export actually. It barely exceeds the threshold of $3 billion. And now with the intensification of this crisis, import bill actually has decreased until I believe until this June. It has decreased by about 50% compared to June previous year, and it's also expected that this volume of import will keep the same pace. At the end of the year, the imports are estimated about $10 billion, which is 50% of the regular rate. Now, with the imports being less, this crisis actually presented a real opportunity for the productive sectors to return. in order to compensate this shortage of import. The industrial sector, it was a pioneer actually in the pre-Civil War period. It accounts for about 14% of GDP. It employs about 22% of the workforce. And there's actually a real opportunity to revive the national industries again and boost the exports, which will contribute to the flow of hard currency to Lebanon. And I have to mention there's a fund, it's called the Cedar Oxygen Fund. It's supposed to be launched today or tomorrow. It's at the end of July, end of this month. This fund actually was an initiative by Lebanese expats in Europe. It's founded on the basis of cooperation between the central bank and some of the major Lebanese banks with a value of $175 million. It is for industrial financing in Lebanon, which is an amazing initiative in these times. A very small one, but with a large impact. And also regarding industry, actually there are significant incentives offered to the industrial companies in Lebanon. Incentives like fees reduction, tax exemptions, export subsidies. You can find it all on the IDAL website, which is the Investment Development Authority in Lebanon. You can Google it, it's there for everyone. The same things apply for agricultural sector. This sector has been neglected for so long and it's outdated. And now everything can be reversed, especially now there are programs being prepared in order to advance this sector again. There is a big investment opportunity to consider. Now, this sector accounts for 3% of the GDP, only 3%. It employs about 12% of workforce. Food exports represent more than 75% of trade with the Arab world. Now, Lebanon by itself is a brand. When it comes to food industry, you don't need marketing for food products of Lebanon. Just mention Lebanon, it's already a brand that doesn't need publicity. Now, Lebanon is not big in terms of land mass, but it has some advantages in terms of climate, of soil, of water access. Actually, food market is a growing market globally. It accounts for more than $200 billion, and now it's growing even more, maybe due to shortages globally and more demand on organic products. This sector has a very large potential to expand in Lebanon. If it adopts international standards and follow export requirements, it's a big opportunity for investment.
Ali, thank you.
Yes.
Sorry to interrupt, but we only have an hour for the webinar. I think we all understand the crisis that Lebanon is in. I believe when the IMF comes in, it's a good thing. It's almost, that means you need help. People are crying for help, and the IMF come with very strict conditions, which is good, because they will sift out the corruption, the bad governance, and all those things, because their loans are conditional on all of that. So it's good to hear that there is some light at the end of the tunnel, and I'm sure, as I will also mention, a lot of these things are happening and will apply in South Africa too. So thank you for joining us today. I'd like to know,
Colin. Thank you.
I'd like to now move on to our next panelist, as Dr. Azar Jamini. Azar is a director and the chief economist at Econometrics in South Africa. And also he is the chairman of SALCOC, the Southern Africa Lebanese Chamber of Commerce. Azar, to talk on South Africa, and I'm sure many of these things that Ali talks about is very prevalent to South Africa. I think you're on mute, Azar.
Thank you very much, Colin, and good afternoon to you, ladies and gentlemen. Thank you very much for attending this webinar. And I have to agree with Colin, as I was listening to Mr. Kumani talking, there were so many familiar issues. There are, of course, some distinguishing issues, and the one very important, probably the most important distinguishing issue, is the fact that we have a freely floating currency, and that has prevented us from landing into quite the same position that Lebanon is in. The rand acts as a shock absorber for the South African economy. But to begin with, the very first sentence that Ali Khamenei began with, in saying, you know, the problems began in 2011, and from then on, Lebanon's economic performance showed a deterioration. Well, can I replace the word Lebanon with South Africa? And in particular, since 2014, South Africa's economic growth rate has maybe not as weak as Lebanon's, but has been far less than the population growth rate. So per capita living standards have fallen in every single year since 2014, ending up with last year being 0.2% growth. And in the first quarter of this year, -2%, following -0.8% in the third quarter of last year, -1.4 in the fourth quarter, -2 in the first quarter of this year. Now, if you bear in mind that the first quarter of this year only had 4 days of lockdown, the rest, the economy was operating more or less as normal. In March, we started seeing some of the social distancing requirements. The fact is that, notwithstanding the fact that we had not yet had COVID in a big way, in the first quarter, the economy was still extremely weak, and last year, the same thing. There were some immediate causes of this, obviously load shedding being one very important one. But also, over and above that, you've got to bear in mind that South Africa has had a myriad structural weaknesses over the past decade, starting off with Zuma's corrupt practices that really have removed hundreds and hundreds of billions of rands of resources that could have been made available to support social development in the country. Secondly, linked to that has been the massive deterioration in the performance and competence of our state-owned enterprises. Many of them have been pillaged by connected individuals for their own benefit. Thirdly, the government began by trying to eradicate the impact of the global financial crisis in 2008 by embarking upon a big stimulus project from a position where very strong at that time, with a public debt level of 22% of GDP only. But instead of spending the money on infrastructure, what it did was it expanded the public service massively and increased the remuneration of public servants hugely. And we are now paying the price for that. Fourthly, and coming to the more fundamental structural problems, education has been abominable. We are producing just so few people with skills to actually sustain a productive economy that we are unable to improve our growth rate. The simple figure that I give as a reflection of this is that 1 in every 40 children who begin school ends up getting 60% or more for maths in matric. And you know, in many of your businesses, you wouldn't employ someone who got less than 60% for maths in matric. Not 80%, 60%. 1 in 40 does that well. And actually, only 1 in every 4 actually ends up passing maths for matric to begin with. Then there's the whole question of the trade unions, very militant, but why? And the reason is because of high levels of inequality and resentment at the fact that those with skills are generating a lot of value added and earning very well. Those without skills are unable to add value in the economy and are being left behind and are not earning. So the gap between the two is getting bigger and bigger. And finally, there is an argument that the country is heavily over-regulated. Now, there are people who disagree with that. Then along comes COVID-19, and we lock down, and that creates absolute havoc. Around 50% of the economy basically shut down in that first month in April. The Stats SA conducted a number of online surveys to see what the effect was, and the official figure is 47.9% of the businesses that it surveyed, over 2,000 of them, had to close down. So that's nearly 50%. That figure has fortunately improved enormously with level 4. It got to nearly 80%, started functioning properly, and obviously with level 3, more like 90%. But there are some significant sectoral losses. The most important ones were, of course, have been in the hospitality industry and in the restaurants and services industries. The property industry has lost badly because a lot of businesses have had to shut down, especially those smaller retailers. And the focus of the losses has been very much on the small business sector. Funnily enough, the banks are also taking strain. It's been very interesting to look at the performance on the Johannesburg Stock Exchange of different sectors, and one has seen that the share price movements have mirrored who are the winners and who are the losers. Now, it's interesting to note that there have been some winners. Telecommunications and information technology have been winners. Food retailing, the food business generally, the pharmaceutical and medical businesses have also done very well. So you can see it's wonderful in economics. For every cloud, there is a silver lining, and I'm going to come at the end of my presentation to just talk about the opportunities. What the government has done is to try and introduce a variety of relief packages, including the temporary employee relief scheme, whereby 40 billion rand is available through the unemployment insurance fund to make up for people who've lost their incomes or have been retrenched. There's also been 50 billion rand given away in the form of social grants to those people who can't survive. They've got no income whatsoever. The biggest element has been a 200 billion rand loan guarantee scheme for businesses to rescue them, to give them loans. And then there's been another 70 odd billion rand given away in the form of, it's not given away, it's just delayed tax payments on PAYE, VAT, and just deferred tax more generally. But many of these relief schemes have become mired in bureaucratic logjams, and the money hasn't actually actually flowed through to the recipients who really need it. The most classic example of that is the 200 billion rand loan guarantee scheme, where only 12 billion has yet been dished out to businesses. There have been a few grants and schemes, the Ruperts, the Oppenheimers, the Solidarity Fund. Those all come to no more than 10 or 15 billion rand. The biggest benefit that people don't highlight sufficiently has been the fact that the Reserve Bank has reduced interest rates by 3%. The prime overdraft rate at the beginning of the year was 10%, it's now 7%. And if you calculate, my calculations show that that is an annualized benefit of nearly 120 billion rand to the economy. And that's going to mitigate some of the negative effects without a doubt. However, there have been a whole host of forecasts of what will happen to South Africa's growth rate. At one point in time, people were talking about -15, -16% growth for 2020. My own analysis says it's not going to be quite as bad. But generally speaking, we're now all hovering around the -7, -8% level. Now, the implications for job creation or job losses is enormous. And already in those Stats SA surveys, they showed that over the first period of lockdown, around 10% of all jobs were lost. which amounts to around 1.5 million jobs in the formal and informal sectors. And that's before you see the knock-on effects. You're still only going to see a lot of job losses emerging in the second half of this year. Make no mistake, as businesses who've been holding in there, trying to survive, are going to throw in the towel and either retrench their workers or close down completely. So it's not all over yet. The real danger that we have is, of course, on the fiscal side, where as a result of the sharp reduction in economic activity, we have actually seen a dramatic fall in government's tax revenues. Around 304 billion rand is the estimate that the National Treasury put forward in its supplementary budget in June. But that some people say that's an underestimate. 304 billion out of a total revenue collection of 1.4 trillion. That's nearly about a quarter of revenue has been foregone. We've got to borrow that money. And that's a huge problem. And that's why we've been downgraded in our credit ratings in a very big way. It's a situation that's been building up year after year. The lower our economic growth rate, the more that we've had to borrow. And this year, we are likely to have to borrow some 775 billion rand to plug the shortfall between what we're spending and what we're receiving in taxes. Now, when you borrow at that level and you've got negative growth, your debt level as a percentage of overall GDP is set to rise enormously. Now, I was a little amused when Ali was speaking about Lebanon's being at 150% of GDP, because ours is, but set to rise to over 80% of GDP this year. And the government intends capping it at around 87% of GDP from 2023 onwards. Would that actually materializes? Because in order for that to materialize, the state itself needs to curtail its expenditure massively. And in the supplementary budget, if you look at the figures, government spending has to decline from 37 to 32% of GDP in the next 3 years. Are the public sector trade unions going to acquiesce to that? Because it means huge cuts in expenditure on public servants. We know that they're already very, very unhappy about it. So there's been a lot of skepticism as to whether the government will indeed be able to fulfill its promises. But upon those promises lies the fact that the IMF has now given us a 4.3 loan, and the New Development Bank has given us a $1 billion loan. We're seeking assistance also from the World Bank for another $2 billion. So we may be able to get a whole lot, about $7.5 billion worth of loans from these agencies. The attraction of that money is that it comes at an interest rate of 1% or very little more of that, whereas the remaining 650 billion rand that we borrow, we have to borrow at interest rates anywhere between 7% and 11%. That's how high South Africa's real interest rates are. The world, to some extent, has lost a lot of hope in us, and that's why they are penalizing us with the highest long-term interest rates amongst leading emerging markets. Even Brazil is managing to borrow money from abroad at 6% instead of having to pay 7, 8, 9, 10%. The beauty as an investor, and Mark is probably going to talk about that, is you can, if you want to take a chance now, lock into long-term bonds at a very high rate of interest and do quite well out of that way. Talking of which, I just want to mention also that from a global point of view, we're also running into a lot of difficulty because worldwide, leading governments, left, right, and center, have had to do exactly what South Africa's had to do, and that is borrow money heavily to fund relief packages for their economies. And this has been overcome to some extent by massive injections of liquidity by global central banks. And these injections of liquidity are leading into a financial asset price boom. Amazingly, those with wealth have seen hardly any reduction in the value of their assets since the crisis emerged. but it's the ordinary man in the street that is losing his job or having to take pay cuts. And this is a worldwide problem. Obviously, in South Africa, because we have an even more unequal society than most other countries, it's even more acute. The rise in unemployment is even more acute than it is in other countries. But there are significant areas of opportunity that have opened up. The world is clearly not going to be the same after this crisis is over. And already we see a lot of people working from home. I wouldn't be talking to you through this medium right now if it weren't for the fact that a certain information technology is receiving a massive boost, and there are opportunities to take advantage and to innovate new ideas of how to cope with this new environment. The other point is that I mentioned the rise in inequality. There's growing resentment around the world towards politicians and leaders, and that is also leading to countervailing trends towards nationalism and populism. And we've seen the rise of a number of politicians around the world who have really been kicking back against the concept of globalization, the leading one of obviously being Donald Trump. And we are seeing trade wars escalating around the world. That together with the fear of disruptions to supply lines resulting from lockdowns around the world that could materialize again at any stage, is creating opportunities for inward industrialization. In other words, businesses wanting to replace imports in a manner that we haven't seen in this country since the days of sanctions 30, 40 years ago. So and we've seen some companies actually taking advantage of this in the pharmaceutical, medical field, even in the motor field, making ventilators and the like. Huge opportunities there. The next area of opportunity is in the healthcare space. There's no question that healthcare is going to acquire a hell of a lot of attention that it's never done before, both in terms of digitization and equipment, but also in the terms of innovative ways of producing healthcare. On the education field, we see how virtual learning, even at school level, let alone university level, is taking over. This is creating huge opportunities in exploiting that area of new business. Not to mention that one of the beauties of the lockdowns was to suddenly see the clean air and the birds singing in the trees of your garden in a way that you haven't had before, highlighting the opportunities that exist in terms of environmental improvements and waste management, which is a big thing in Lebanon, obviously. And then finally, on the side of security, there are great opportunities available to improve. Cybersecurity is going to be one big question mark and area of weakness in the world economy if it's not attacked. But conversely, it provides opportunities to actually overcome that. And the final point to make is that the world's population, even after COVID, is growing older and older. And as a consequence, there are huge opportunities either in retirement annuity, in retirement funding areas, or in terms of providing retirement facilities for a lot of business to take place. Those opportunities are there even with the ravages that the COVID-19 virus is inflicting upon the economy. So it's not a pretty picture in South Africa at the moment. The government has plans to try and recover this economy post-COVID, but unfortunately, what we run into is two massive fault lines. The first is factionalism within the ruling party that is not allowing President Ramaphosa and his immediate team to do what they want to do to restructure the economy and to attack corruption. And the second is the ideological split within the ruling party between those who want market-oriented solutions and those who say we need more, not less, government involvement and regulation to overcome. These are huge challenges. They exist, fortunately, in other countries as well, but don't overlook opportunities that also come with this kind of situation. Thank you.
Azar, thank you for that. as Warren Buffett says, he says, don't let a good crisis go to waste. And I think we, as you've mentioned, there are some positives. Similar to Lebanon, we're forced to produce locally. We are competitive. I think certain industries will emerge. And, South Africa and Lebanon have proved to bounce back. In the past, they've both been in dire positions and they have bounced back. And I do believe that, with the right governance, with the right mindset, I think the IMF is a good thing for discipline. And with these things in place, I think we have an opportunity to bounce back. So thank you. So with that, I'd like to move on to our final speaker, which is Mark Khalil. And Mark is with Standard Bank. He's head of the Syndicate Africa. And Mark will look more at the micro sort of statistics and factors in South Africa. Mark?
Thank you, Azar. Thank you. I'll be picking up a lot on what you said. As a lot of you know, the capital markets are a passion of mine, and it's a pleasure to be able to share these insights. Just from a Standard Bank point of view, compliance, I need to state upfront that my views are independent from theirs, but I've had enough experience across asset classes. COVID-19, these are unprecedented times, and the impact has had far-reaching consequences into our lives and the markets. COVID has been devastating, destructive, and in March, it sent shockwaves through the market, coming like a thief in the night. It's had its impact across asset classes, and that's what we're going to focus on. I'm just going to be sharing the screen here. I want to make sure that you guys can see this. Colin, just tell me if we can see this.
Yes, we can. It's not full screen. I think you can make it full screen, Mark.
Okay.
That's it.
Okay, so it's impacted international equities, South African equities, bonds, gold, oil, and the rand. As a summary of events, I've classified the timeline of COVID into three parts, namely the crash, the intervention, and the recovery. The crash. 11 March, World Health Organization declares a pandemic. World stock markets plunged 25%. As Azar has alluded to, GDP growth forecasts down. The Reserve Bank said last week that SA projected down 7.3% for 2020. Oil crashes to historic lows. Brent crude, which typically trades in European markets, hits an 18-year low, and more restricted to the US, WTI oil trades at minus $40 a barrel. They're paying you to take it off its hands. There's a flight to quality into the safe haven of US treasuries, where people are preserving capital. They're getting 0.5% in dollars, but they're not losing money. The stronger dollar cripples emerging market currencies. We see the rand hitting a record low of 1935, and immediately there's an impact on your commodity producers. Ghana, a market that I cover, 30% of its exports are oil, so revenue will be hurt. Emerging market bond yields spike up and hit multi-year low, the highest. But you can see that.
Yes.
The government intervention is swift and meaningful. On the oil side, there's resolution, and they eventually agreed to cuts, so oil rallies. The global stimulus packages then enact a market rally. Azar's spoken about the fiscal support. I don't know if you guys can all see it here, but there's $11 trillion of injection of fiscal support. That's 14% of global GDP, $11 trillion. That's in the form of social grants, giving people money. In America, it's $1,200 per person who qualifies. Loans to banks, bond buybacks, anything to get the markets working. In South Africa, 500 billion rand, spoken about by Cyril Ramaphosa. And this week, the IMF agreed to do COVID relief for $4 billion. The Fed said this was the worst crisis in history. US GDP growth soars to 103% from 88%. On the positives, they commit to keeping rates in the US low at 0% till 2022. That's massive. Where are people going to invest? They're hardly going to be investing in bonds, in money market, equities is risk on again, and you see this worldwide rally, as well as a spark in gold and precious metals. The market recovery is swift and decisive. Redeployment of cash, especially into growth opportunities. We see a surge in the metals of gold, platinum, silver. We'll touch on that. In terms of asset allocation for the funds, Alan Gray, Investec, and the like, they expect to see equities outperforming bonds and money market. New corporates looking to come to market, low equity levels. This is cheap funding for them. And we've seen record issuance globally in the first quarter. So they're talking about a V-shaped recovery being priced in. Colin and I yesterday spoke about a risk of COVID-2 wave. This is the graph that I'd like to discuss, but just before that, I'm going to open it up to Colin. Any comments, please?
Yeah, Mark, two comments. I mean, you've shown a V-shaped recovery. I think the markets have shown a V-shaped recovery, and that's really stock markets. And my concern is the underlying companies, and yes, you have the very successful, in the US, they call it the FANGs and the FARMs, which is your Facebooks, Apples, Netflix, all of those, Microsoft. And in South Africa, we have the resources process, which I think are the minority. And my worry is, what are the chances of an L-shaped or a U-shaped recovery? And a U-shape is where there's a protracted sort of low growth, and then it recovers. And an L-shape is where we never really get into a recovery mode and could eventually just, become move into a recession and depression.
Okay. I don't know if everybody can see the full screen, probably not, but I can talk about it. So this graph is your FTSE World Index. It's 3,100 companies. And essentially you're looking at COVID versus other market crises. If we look at the left here, this was your dot-com crisis in 2000. Then your global financial crisis, 2009. What's interesting about this, and to answer your question, Colin, the sell-offs took time. It took 30 months. It took 2.5 years for the dot-com crisis to crash and hit its ultimate low. It took 1.5 years for the GFC to hit its low. In terms of their recoveries to 90% of their pre-crisis highs, it took 6 years. What happened with COVID? I don't know if you can see it here, but it took 1 month from its peak to its low, and it's taken 4 weeks to retrace to 90% of its high. So when you look at previous crises, it looks more like an extended U, looks like a sideways L, and in this case, it looks like a V, but that's only on the assumption that there is a lasting recovery. If we look at the markets, what they've done, global equities up, volatility index down, gold up, we'll talk about it, oil has recovered, and money market funds have come down. So people are looking for opportunity again. If we look at the international equities, and I'll get onto this with your question, Colin, you mentioned the FANGs. That's your Facebook, Apple, Amazon, Netflix, and Google, which is part of Alphabet. These are your American stocks, the top 10 by value versus your South African stocks, the top 5 by value. The key themes here, growth stocks have outperformed value. We're talking about your lockdown friendlies. So Apple, Amazon, Facebook, Google, collectively they're making up 20% of your S&P 500 market capitalization, which is $28 trillion. South Africa's market cap is less than $1 billion, it's 850 billion. But the point is that these are leading the rallies. In the last year, the US top 5 have been up 50% in dollars. South African top 5 up 9% in rand. The leaders have been these stocks, but what I must point out is that the banks in America, JP Morgan Chase is down 30% in a year. There are a lot of stocks in the US that haven't been the catalyst like it has for the techs. The important thing here is that the underperformers have been your global banks, your retailers, your real estate. But Azar's already starting to allude that in South Africa, we're starting to see signs of those underperforming sectors starting to pick up. Colin, any comments there?
Yeah, Mark, I think, in my view, that one needs to, when you look at these stocks that have overperformed and say, well, how much more can they go in the next 5 years? And personally, I am concerned that this recovery, this V-shaped recovery, may not be sustainable, and it may turn into more like what they call a W, which is another one where we have a recovery and then we have a drop and then it recovers again. So I hope I'm wrong, but that's just my gut feeling. And I think also I think things that is liquidity, which has driven these markets, is that you can't put your money into cash, you get no return. You can't put it into property, it's dropped off tremendously. So what other options do you have? And I think equities has become an option, and not only for the investors, but for the man in the street. You know, I've heard horrible stories about people who've been given all this $1,200, $1,500, paycheck every month, and you have these young sort of people just betting on the stock market at big risk and going insolvent because they think they know what they're doing and they see these markets moving. So I think there's a whole other dynamics that have been created and that have been pushing these markets. But time will tell, how sustainable they are. And I think the other thing which I just find staggering is when that West Texas oil index, where it dropped to minus $37. I mean, as we discussed yesterday, if only countries like South Africa had captured the moment and they would have been paid $37 to buy as much oil as they could over I think 2 or 3 days, it would have been a great opportunity.
So just on the PE and the valuations, I agree with you. As playing devil's advocate, Amazon is on 147 times PE. When I was in New York in 2000, the NASDAQ was on 526 times multiple. Obviously, the techs were just starting, but you're basically saying in 5 years' time, will Amazon be growing at 4 to 5 times its business? And at this stage, there has to be a question as to whether the recovery is going to be that strong in the USA. Once we look on South Africa, this is the COVID period. From the low, 19th of March to the 30th of June. So it's basically your COVID period, your second quarter. What we haven't looked at is July so far. And Azar said that you've started to see a pickup in food, in healthcare, more in the banks. Yes, Standard Bank guided, what was it, 30 to 50% down for the headline earnings, versus a previous consensus of 60% down. And the stock rallied 5% yesterday. So we're saying, is the worst out of the way? In terms of this slide, if you look at it, in this COVID period, what outperformed? Your golds, your resources, your chemicals. What underperformed? It was the sectors we'll talk about. But what's important here is these numbers weren't down in absolute terms. This is underperformance to the all-share index. So the all-share index, the JSE, was up 43% in this period. We're saying that the golds and the miners and resources outperformed by a further 96%. And even though the banks, real estate, travel and leisure and food were down, they underperformed in absolute terms, they were up. What's important here? Rand hedges are leading the way. Their product sales are in dollars, their costs are in rands, and obviously we're seeing that reflected into the SA market. Colin, any comments there?
Yeah, Martin, I think, the great slides, I think some very interesting statistics. And, we just need to be, I think we need to be cautious. I could just say to everybody, one might look at certain things and jump to conclusions or jump to actions. I think we need to have a measured approach. And, as they say, things never happen according to plan. Often they're better and often they're worse. So I think time will tell. Thanks, Mark.
JSE leading the way now. We look at the South African bonds. This is what Azar alluded to. If I just give the key themes here. Foreigners were net sellers of South African bonds and equities year to date of 60 billion rand on each. We had a recovery. If you look at the second graph, that's your current yield curve on your South African government curve. The third graph are your African sovereign bonds. Those are your government bonds. COVID came, there was this massive spike, yields went up 2-3%, it's since recovered. What's important here? It's the positive. It's called the carry trade. It's exactly what Azar was saying. You're getting foreign investors coming back into the market now. They're getting 11 to 12% on the South African bonds. You say less inflation of 3%, they're getting a real interest rate of 8% versus Americans who can get 0% real interest rate. So as long as the rand does not depreciate by more than 8% a year, you're basically going to be making money, and you've seen this recovery. All I want to do is just quickly tell you what was the impact during COVID. We saw the sell-off on the bonds. South Africa obviously was downgraded. It exited the World Global Bond Index. There was outflow. We saw foreign selling and local selling, and obviously there was a tick up in yields. Restoration of the bond market. Azar's already talked about the 3% cut, but you've had new liquidity coming into the bonds. Every week, the Reserve Bank has been issuing 20 billion rand of issuance, and they've been buying back bonds in the secondary market. So this is all available cash coming into the market. The banks are lending it onto people, and you're trying to stimulate the recovery.
Thank you, Mark. Sorry.
Colin, I'll just tie up here with gold and oil.
We're just running a bit short of time, so I think tie up and then I'll give a quick conclusion.
Just on gold, we wanted to say that the rally has been up 57%. There are so many catalysts right now calling for a strong gold price. Analyst forecasts are from $2,000 up to $3,000 an ounce. And at this stage, it looks like it's having a 1 in a 10-year rally, and it's going to sustain itself. On oil, we've already talked about oil. I just wanted to say that the reason it was simultaneous, lots of supply, lack of demand, and essentially you saw the prices coming off. The reason it hit negative numbers, it was the inverse of a short squeeze. People were long contracts, and they couldn't take delivery. There was just this huge inventory supply, and eventually they had to sell. The markets have since recovered. The last thing to say on the rand, after hitting a record low of 1935, it's currently just below 17. The banks are calling for it below 16, all things being equal. The technical outlook is positive since May. In COVID, it was one of the worst performing currencies amongst emerging markets, but at this stage, with foreigners coming back into the markets, we do expect the rand to firm. That's all from our side. The last comment I wanted to say was that, and this is my motto when I invest, invest like a bull, sit like a bear, and watch like an eagle. So we're hoping that we can get some better times. Thanks.
Thank you, Mark. I think just to conclude the session, I just want to thank all the panelists. I think they gave us some excellent insights into both what's happening in Lebanon, what's happening in South Africa, and it's quite amazing about the similarities between the problems in both countries. But having said that, I think they're both very resilient countries. Both have proved to have gone through some terrible times and have bounced back. And I'm one of those who like to believe we can bounce back. And if we have just the right management, right leadership in place to drive us through, this crisis, the governments are, definitely putting the stimulus packages in place to assist this. And as the IMF once again is a good thing for the country, creating fiscal and monetary discipline, and to get rid of corruption and bad governance. So my passing comment I would say is that we must be creative in these times of crisis. We must think differently, and in formulating that thinking, we must try and look at the difference between the fact and the fiction. There's too much fake news, and people react too quickly to this news, which I think creates a lot of tension and stress in the system. And finally, I'd just like to mention, in listening to David Rubenstein from Carlisle, he's one of the largest private equity players in the US. He's now retired and he's a philanthropist. And he says the wave of there's almost a pact that all the billionaires are signing that they will give away most of their money because they do recognize this, what I call COVID crater, and this diverse between the rich and the poor. And I think more important, he said, philanthropy is not only giving a check and not only giving money, but it's giving of yourself to less fortunate people. And I think I'd like to end off on that note, and to thank everybody, thank the participants, and thank all the people who dialed in today. Thank you for your time and the efforts. And finally, just two last things to say is that the Selcock website is open for membership. Anybody who would like to join, those who haven't joined, we encourage you to join. And also our host today is Cartel Club, which is a bespoke networking platform, have hosted this event for us, and they are running some good specials. And Shirley Sims, who is in charge, has said please contact her if anybody is interested. There's a 99 Rand special on per month, and her contact detail is 083 480 8888. 083 480 8888. And this session has been recorded for those who had to maybe sign off, or those who have friends who would like to listen, or those who just would like to listen again. So thank you, specialists, panelists, participants. All of you stay safe and best regards. Thank you.